Welcome in to Make Your Money Matter. I'm your host, Barrett. Today on our show, we're gonna talk about how to win more by losing less. It sounds crazy, but hear me out. One thing I learned early in my financial advising career was our job as a good investment manager, and I think good advisors everywhere, is to be less wrong more often. And now we're just coming up here on the Super Bowl, the great game, and I wanna talk about that in context and how that relates to your money and what it has to do about looking at offense versus defense. But before we get started, make sure to smash that subscribe button, hit the notification bell so you don't miss a single episode. All right, let's get into it. Real quickly, in thinking about and writing today's show, I was reminded, speaking of the Super Bowl, of a certain game, a certain Super Bowl in 2015. I want to bring this up, but it also has brought up something that has nothing to do with football at all. But do you remember, or have you ever heard the expression, snatch victory from the jaws of defeat? It actually comes from the Mexican-American War. Now, real quick, just a little bit about me, by the way, if you watch and follow me. I'm kind of a weird U.S. history buff. I've always found it fascinating. I've always just taken to it. But it came as an example here with regard to this American lexicon that many of us have heard, right? So those of you who have heard it, because the way this war went down, it's actually, by the way, how we acquired New Mexico and California, my home state, because during the war, a regiment of American troops from Virginia won a really hard-fought battle, and a politician wrote that they snatched victory from the jaws of defeat. Now, as we all know, and as I said, like you heard this before, it means that you win when it appeared that you would lose, which by the way brings up 2015. Now, real quickly, in 2015, if you recall, in the Super Bowl, it was the New England Patriots who played the Seattle Seahawks in the Super Bowl. A CBS sports writer wrote in a post-game writing, this is what will transpire, will live in the annals of this league for as long as football games are played. Basically, a series of decisions, including the bizarre call by the then coach Pete Carroll to throw the ball in second down on a receiving route in the crowded middle of the field. That will always be second guessed by any football fan out there as we're here on the Super Bowl, right? So for those of you who remember this, Coach Carroll took a huge unnecessary risk, and he did it late in the game when there was really no time to recover. And actually referencing the coach's play call, actually one of the former NFL players tweeted, it was the dumbest play call in the history of NFL football. Now, the outcome of this game, as many of you know, was much different than what could have been for Seattle. By the way, sorry to my Seahawks fan base, I have a lot of friends there, but all because of what? It was bad judgment. So the Patriots snatch victory from the jaws of defeat. Essentially, Seattle was about to win, but they chose a bad play call and bad judgment. Why am I bringing this up? Well, number one, we're here on Super Bowl season. We just had the game, right? But I also want to talk about this idea when it comes to your money about winning more by losing less. And when talking about this, we have to come out here with a statement that I think is super important. I'm just going to put it out here, all right? All returns are not created equal. Friends, this isn't an equality discussion here when it comes to your money, all right? All returns are not created equal. This is due to what? Math. And here's what I want to bring up, all right? I'm going to put a graph up here in a second because when it's due to the math, when you look at it here, when you put the math to work, all right, and you talk about recovering losses, let me give you an example, okay? It's easy to believe, many of us believe this before I put the graph up here, and I've talked to, again, many potential clients and clients around this subject, and it's likely what you're thinking as well, right? When you clicked on this video and you wanted to watch it, there's a key takeaway here. It's easy to believe that if you lose, let's say hypothetically, 50% in your investment or whatever investment it might be, and then you gain 50% the next month or next year, you should, in your head, return to your starting position. But do the math. You would actually need to gain 100% to break even from a 50% loss. That, friends, is why successful investing is not just about what happens during bull markets or in rates of returns that are positive. Right? There's an old saying, right? Bears sound smart, but bulls actually make money. Your returns during bear markets can be just as or potentially even more important. And I say this often to our clients here at One Capital, and for any clients watching or listening, right, to this video, and or if you're not a client, you're talking to your advisor or even looking at us to see if we can help with those things. Here's what I want to bring up, that a rate of return to your portfolio, right? Which, by the way, everyone loves to focus on. A lot of people on these channels and everyone out there wants to focus on returns and what they're doing great and all this stuff. But a return will always only be one half of the story. Okay, sorry to say this, but the redheaded stepchild out there is your losses. Risk management is a huge part of portfolio management. Managing your downside risk is equally as important to managing and earning your upside potential. Again, your returns during, say, a bear market can be just as or potentially even more important than even a bull market. So let's put this graph up here for a second. And as I say this, there's a study here by Blackrock that I'm showing this, and it has a lot to do with what I'm bringing up, all right? Now, this is just for illustrated purposes, but I want to bring this up simply to illustrate, again, the math. Again, the greater the loss, the harder it is to break even. That's why managing, again, your downside or being diversified and managing your downside risk is so important, all right? Everyone, again, loves to talk about the upside. Trust me, I get it. But managing your downside has a lot to do with your success with your money, which is, by the way, what everyone wants, right? You want to have success with your money. So take a look at this graph. Now, on the top left here, as you can see, it has the example I gave you about $1, right? If you have $1, you lose 50%, you're at 50% of that number, right? You can see that if you have a 100% rate of return, you're back to $1. Said differently, do some, quick mind math for a second, and I'll get, into this here, but imagine you have $10 and you lose, let's say 10%, hypothetically, okay? So now you have $9, and you imagine you earn 10% back the next year. You think, hey, you're doing the math. You're like, okay, I lost 10%, I earned 10%. Guess what? I'm back to even. No, because when you lost the 10%, you now had $9, and 10% on $9 is only 90 cents. It's not a full dollar. So you're not even fully there yet. Now take again a look at this graph. The bottom part, or the underline here, as you can see, is the downside loss. And I love how they put this together. If you lost 5%, 10%, 20%, and so on, and the corresponding above the line is what you would need to earn to get back to even now. No, okay, look at something. The 30%. You can see when it becomes 1 or 1.4 times the loss, then all of a sudden you go more of a loss, you go out to 50%, you can see it's 2 times the loss, or 100%. That was my analogy earlier. Now go all the way to the right. If you lost 70%, as again, a huge hypothetical here, you would have to earn 233%, or 3.3 times the loss, to get back to even. Do you see how managing your downside risk is so important? And by the way, think about times when this has happened. Think about the March or springtime of 2020 during the pandemic. Think about the 2008 during the financial crisis, or 2001 during the tech bubble. These are really important to talk about. Or even 22, a little over a year ago, right? When there was a bear market, they were off over 20%. And you look at this graph and you say, okay, if I go down 20%, I got to earn 25% just to get back to even, not even positive. I mean, having a diversified portfolio is really what matters here. Because again, I know it sounds boring, but if you think about it, working with an advisor, as painful as it might be sometimes, or you don't want to do it, right? You might be thinking, I'm not earning as much as, say, the market or my friends or whatever. And there's a reason for it, because if we can manage your downside risk, that means when things come back, and by the way, the last 2 years is a great example, right? So 2022, markets were off, like I said, a little over 20%. And 2023, last year, as we saw, they were up about the same. But for many people, okay, you're not fully back to even. Why? Because of the math. So I wanted to share that with you today, because it's really important, and make sure you talk about it within your household or within your conversations with your advisor. And again, we're happy to help with these things as well, because again, managing your downside risk is equally as important as your upside earnings. Hey, I hope you enjoyed that today. If you did, make sure to subscribe to our channel so you don't miss a single episode. And always remember to make your money matter.